Now, while those profit statements might be positive, the state of the market in the past 12 months swept away the confidence for investors to take on new companies. The number of IPOs or new share market listings pretty much collapsed, and most companies are lower than their listing price if they did get onto the market. Edward Boyd trying to find out whether things will improve this year.
Last year was the worst year for share markets since the global financial crisis. America's S&P 500 was down almost 20%. The Dow Jones dropped about 9%. The tech-laden Nasdaq plunged 33%, and the ASX 200 dropped 5.5%. Investors lost confidence. Their appetite for risk evaporated as share prices fell. As a result, IPOs, initial public offerings, share floats, dried up too.
We were coming off the back of a record year in 2021. We had close to 200 IPOs hitting the market that year, so it's always going to be difficult to try and replicate those sort of numbers. And 2022, the market sort of started okay for the first 6 months, but we saw a real drop-off in IPOs towards the end of the year.
HLB Mann Judd counted just 87 new listings last year, down from 191 the year before. Just over $1 billion was raised, down sharply from the $12.33 billion in 2021. 78 of last year's new listed companies were small cap stocks, and 72% of all listings were from the materials sector. Think battery materials, including lithium. HLB Mann Judd partner Marcus Ohm says rising interest rates discouraged a lot of prospective companies from listing.
There's been a lot of geopolitical macro factors, certainly things like China have had an influence, and also Ukraine and energy prices. But certainly as far as the IPO market goes, it's been more interest rate driven. Interest rates are generally not good for the wider equity markets in particular, and also companies and sectors like technology tend to struggle when interest rates are higher. We've certainly seen that in the Australian context, but also in other places around the world as well, such as the US.
But here's where things get worse. Only 48 of the 87 new listings recorded a gain on their first day. Just 5 listings jumped more than 100%. It was no bonanza for listing junkies. The top performing IPO for the calendar year was lithium exploration stock called WA1 Resources. By contrast, payday lender Before Pay slumped.
I think the share price performance overall last year for IPOs, we had a loss on average of 2%, but we've got to take it in context. The wider All Ords was down by 7% over the calendar year. There were some really good gains to be had. The top performing IPO last year was a company called WA1 Resources. That was up by 598% over its listing price, so they had a great result. We also had some companies, of course, that weren't quite as good. They tended to not be the resources companies which did perform well, but other sectors such as diversified financials. We did see the worst performing stock was a company called Before Pay Group. That was down by 86%, so that was a very difficult result for them and probably reflective of the conditions in that sort of sector.
It's also worth noting that 2021 was a record year for IPOs, with markets on the way up and interest rates being held at record lows. Some of the biggest listings included asset manager GQG Partners, employment services company APM Group, and property company PEXA. But 2022, it was mostly small cap companies, particularly mining exploration businesses.
Yeah, the materials sector and also the energy sectors did really well. So 3/4 of listings for the year came from materials companies, small materials companies. And in fact, 3/4 of those listings actually came from Western Australia. So for the small cap junior explorer from WA, it was a great year. But for other sectors, it was really few and far between.
This year, with global interest rates nearing the peak, there's more optimism for the local IPO market. More might be tempted to dip their toe in the capital markets. But the market isn't expected to pick up until the second half of the year.
I think the first half of 23, I'd imagine that we'd see a little bit more of the same. So we'll continue to see those smaller resources companies listing, particularly in areas like gold. And also lithium had some amazing price growth last year, and it's forecast to continue into this year. So some of those lithium plays, there's a couple that are seeking to list already, will continue to trickle through the numbers. Any sort of meaningful improvement, I think, is going to be the back end of 23 as we start to see hopeful interest rate cuts coming through. There is the rumoured listing of Virgin, which may be at the end of this year, perhaps going into early 2024. It's really crystal ball stuff. We've definitely got to see how that macro sort of factors play out in the year ahead.
Now, this is all part of a backdrop that central banks have had to consider as they've made interest rate decisions this week. The US Federal Reserve, after a series of rate rises of 3/4 or 0.5%, tapered back to 1/4%, as it said inflation in America has peaked. But Chairman Jerome Powell made it clear the job isn't yet done and there will be more rate rises.
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Meantime, the European Central Bank and the Bank of England, both with serious inflation outbreaks, raised rates by 0.5%. But even there, it was a view that inflation is close to the top.
We've seen the first signs that inflation has turned the corner. Annual consumer price inflation has come down from 11.1% in October to 10.5% in December. That's below where we thought it would be in the November report. And we think it will continue to fall this year and more rapidly in the second half of the year.
With all this as a backdrop, this week Ed Boyd caught up with Kerry, global market strategist with one of the world's biggest financial services companies, JP Morgan, to understand just how the world changes as central banks ease back on these rate rises.
I mean, it was a case of what really went right. I mean, we had central banks that were aggressively increasing interest rates to fight inflation that was at multi-decade highs. We had still a China that was in lockdown and pandemics. We had concerns about whether we'd see a recession around the world. None of that really fit into the narrative of thinking around good investment opportunities, and we saw equities really fall quite dramatically in a historical context, more than 20% down, and we saw, unfortunately, bonds also falling as they reacted to that higher inflation and higher rates, which meant they weren't really there to protect portfolios for investors, and so in combination, that wasn't a great year for investors.
The outlook for this year, is it any better than last year? I know you've talked a bit about the 3-speed economy. Can you just explain to viewers what that is?
I mean, it is a better year and a better outlook thinking about what the return potential could be for markets. And it does come to that fact that there will be opportunities around the world. I mean, there was a case of thinking about, will we fall into recession in the US earlier this year? What will Australia's economy do? In the last few weeks, we've had much better news. We now see a Eurozone economy that's likely to not fall into recession and actually expand because they've done such a great job at filling up their gas storage tanks. They're unlikely to have to curb production and manufacturing to keep that up. We do know that the US economy is waning. It's slowing down, so that's going to be something that is going to still be a risk out there. But, even that, it's probably 50-50 whether we do see a recession because you didn't have a boom in many sectors, so you're unlikely to have a bust. And then it comes to China. Obviously, we've had that reopening that's happened, the dropping of those COVID restrictions much more quickly than we had expected. And so there you have an acceleration. So you've got a slowing US, a China economy that's accelerating, and a European economy that's going from contraction to expansion as well.
Yeah, the Aussie market is up pretty strongly over the first month of this year. Do you think traders are being a bit too optimistic?
It's always about what's in the price when it comes to investing, and across the world you've seen a pretty strong run in equities from late last year actually continuing into this year, and that's that expectation that you are going to get this bit of a Goldilocks scenario where we see inflation fall, central bankers really step back from hiking rates, and also no recession around the world, particularly in the case of the US. Now that's probably happened faster than we had expected, so we'd be a little bit conscious that anything that happens to upset that narrative or creates an air pocket could see a bit of a pullback in the equity market. And you've got to remember, when we are in a bear equity market that has dropped more than 20%, it's not unusual to see the market rise and then fall again. So we'd just be a little bit cautious about the attitude towards owning too many equities at this point of view. And we think there's probably lots of opportunities in the fixed income space as well.
You mentioned central banks. The US Federal Reserve lifted rates again this week. How far behind is Australia falling from its global peers?
I think it's all about setting interest rates that are right for the economy. We never expected the RBA to have a level of interest rates or a cash rate that was the same as the US. I mean, the US had a much bigger problem with inflation. They had a much bigger problem they had to try and curb in terms of what drives that inflation, with wage growth being, close to 6%. Australia hasn't faced those same ramifications. They don't need to have an interest rate that's as high. What's important is that central banks in 2022 went from 0 to 100 when it comes to thinking about the speed at which they tightened monetary policy. And now they can really start to think about moving towards a pause and actually being at the end of that rate hike cycle and not near the beginning. And the RBA is there as well. So we expect the Fed will probably hike rates again in March. We think the RBA is going to hike rates in February when it meets, and that is probably likely towards a pause as well, as we do know that monetary policy acts with quite a considerable lag on the economy. We have to see how it's going to impact the housing market, how consumers are going to react, and they don't want to over-tighten policies to really curb more growth than they need to.
So rates in Australia could peak at 3.35%. Do you think inflation has peaked in the December quarter as well?
I think it has, and that's really down to the fact that you are seeing now falling energy prices around the world. If we look at oil prices or natural gas prices, we're also expecting food prices to come off. Those are two big components. We think about headline inflation and what we really feel as consumers. And then we do know we're going to see slowing activity in the housing market. And again, as the borders open up, we get more migration coming through. We're going to ease some of those concerns around the labour market, and that wage pressure, which drives a lot of the services inflation, is likely to start to come down as well. So we would expect inflation to fall across the course of this year, heading back down towards where central banks want it to be by the end of this year. The question is just how close we get, and whether central banks really want to hammer inflation back below their targets.
We also had retail sales figures out this week showing sales fell almost 4% in December. Do you think that was consumers tightening up their spending due to rising mortgage rates, or did they just do their Christmas shopping back in November?
There's a lot of seasonality when it comes to much of this data. I think a lot of that happened back in November in terms of that spending, taking advantage of those sales rather than thinking about it just being delivered within December. When I look at the Australian consumer and we compare them to others around the world, it is a case of thinking about the fact that we still have an elevated savings rate compared to what we see, say, in the US, where it's been used up. That's very much support for thinking about the consumption. We still have a consumer that is looking at the labour market and thinking there's still opportunities for jobs and wage growth is moving higher than it has been for some time. So that does support their outlook. But we would expect them to tighten their belts a little as we think about rising mortgage rates come through, that rolling off of fixed mortgages that's going to happen this year. And so obviously consumer activity will slow in the economy, but not to a point where we really think about it creating a recession in Australia.
And just finally, what do you think is one of the biggest risks to Australia's economy this year? Is it those $370 billion in fixed mortgages coming off over the next 12 months, or is it something else?
There's always been concern with the leverage in the housing market in Australia, just how high it is by international standards. I think we must contrast the fact that we are going to see that big reset in mortgages with what's in offset accounts and how much cash is actually in balance sheets, or how much cash is actually in bank balances across the Australian economy. So I think that'll mitigate that to a certain extent. I think it's definitely going to be an area of thinking about how do we get rid of that deleveraging in the household sector, and really whether we see the global economy continue to grow. Australia as an open economy is going to benefit from more global growth, and so as long as we see that resumption activity in China, improvement in Europe, that's likely to feed through to positive sentiment towards Australia. The biggest risk here, I think, is still when it comes to the central banks over-tightening and killing off that growth more than anything else, with what could be a relatively mild year for the economy, but still one that's only roughly about trend growth, so nothing super in that sense.
Well, Kerry Craig, Global Market Strategist at JP Morgan, thanks so much for your time.
Thank you.